So today we'll be talking about the different SEC filings and going over enterprise value. However, first, before that, let's just go over the accounting statement from last week. So here, this is pretty similar to what we went over during the Ed series, but there are a few number changes as well as some things that I will talk about. So here you have the first line is generated $550,000 in sales, 50 of which has yet to be collected, and then 50,000 of inventories and 60K of SG&A that does not include a DNA portion of that were used up. And again, the only reason I included this part was to make the numbers work. Realize a mistake, so I had to put this in, or else the exercise wouldn't have made a whole lot of sense. But so to begin with, we had $23,000 in sales and $50,000 of which yet to be collected. So we add $50,000 of accounts receivable. And note, the balance sheet is carried over from last year because it is measuring the company's financial situation at a certain point in time. And then $50,000 of cost of goods sold. So this is minus $50,000. And because we use $50,000 cost of goods sold, we also must decrease inventories by $50,000. Or because we use $50,000 inventories, we must also decrease the inventories account by $50,000. And then we have $60,000 of non-DNA SG&A, so we'll be coming back to this later. So this is $60,000, and they were used up to generate those sales. Cool. And again, this has huge cash implications, but we're using the indirect method, and so does most companies. So we'll be calculating the cash flow statement later. And next, we purchased $60,000 worth of supplies used to make hot dogs, and they have yet to pay the supplier for $25,000 of those supplies. So this represents an increase in inventories. So this is adding $60,000 because we purchased $60,000 worth of supplies, and we have yet to pay the supplier for $25,000. So we add $25,000 to accounts payable. We collected $20,000 from those who still owed the truck money from goods previously sold and delivered. So we collected $20,000. And that means we have a decrease in accounts receivable. So this is subtracting out $20,000. And we spent $10,000 trying to develop a new type of hot dog. So that represents research and development expense of negative $10,000. Next, we paid our suppliers for $15,000 worth of inventory that was owed. So that represents a decrease in accounts payable because we're paying our suppliers for inventory. We paid down $5,000 of accrued expenses, and that gets to zero. And we used up $20,000 worth of insurance, but in November we purchased $25,000 worth of fire insurance for fiscal year 2018. And note, this $20,000 is included in SG&A, but because in the top line it includes all SG&A that does not include amortization. So therefore, it's already factored into the $60,000. So we have our prepaid insurance being using up $20,000 of it, but we spent $25,000 to purchase more for next year. So that is prepaid insurance. So we get $25,000 in the prepaid insurance account. Next, we experienced $20,000 in depreciation to PP&E and $15,000 of its to intangible assets. So first, on PP&E, we depreciated $20,000. And so in the last time, I specified that this is, in exercise 1, I specified this is the stove and this is the customer lists. So COGS and SG&A specifically. I did not specify in this exercise, which made this kind of ambiguous. So you could either distribute it into either of these categories. So I just chose to do $20,000 to depreciation to COGS and $15,000 to SG&A. However, since it was ambiguous, as long as I made it to one of these two lines into the expenses section, it should be fine. So then you have minus $20,000 of additional COGS expense. And for the intangible assets, you have $15,000 of amortization. So intangible assets goes down by $15,000. And we have additional SG&A expense which is $15,000. We spent $20,000 buying a stove, so that is an increase in PPV because we bought another stove. And then next we paid an interest expense of $3,500 and earned $1,000 of interest from cash in the bank account. So you have $3,500 here. You add $1,000 because of interest income, and you get that. And then you pay down $20,000 of loans. So that's a reduction in long-term debt for a total of $40,000. Finally, we repurchased $10,000 worth of common stock and paid out $10,000 worth of dividends. So common stock, again, it's just a decrease in common stock because of stock repurchases. And then return earnings goes down by $10,000 because of dividends. Now we have all you need for the income statement and cash flow statement. So gross profit is this. And then we have our operating income. We have our operating income of $95,000. We add those together. And then tax is 0 because I forgot a line about it. I'll talk about how that impacts everything later on. But apparently in this floor there's no taxes. But if there were, it would just represent another expense that flows into retained earnings. And then cash, again, we use the indirect method. We'll get that from the cash flow statement. So our current assets is adding everything together. Currently $150,000, $55,000. Then we add those together. And unearned revenue stays 0 because there's no line modifying it. So then we have that, add up the total liabilities and current liabilities. Those equities stay the same. And you end up getting this. So then you have total liabilities plus total shareholders equity for $519,500. Let's see. Right. Okay. Let's see. It seems I'm forgetting something. So let's go to the answers here. Oh, right. So, one final thing we forgot is we need to add up the net income into the return earnings because net income flows into current earnings. So then we get $612,000 of total liabilities and shareholders' equity. So notice how they are currently imbalanced. Right now, the two parts, the assets and liabilities. Again, accounting equations, assets equals liabilities equals owner's equity. But we had not factored in the cash flow statement yet, and those should make it balanced if we have a working model. So then net income flows down from the income statement. So with D&A, we add back our non-cash D&A, which is a non-cash expense. So here you can see we experienced $20K in depreciation, and $15K in amortization. So we have $20,000 plus $15,000. That's $35,000. Increase/decrease in accounts receivable. Again, you subtract out an increase in accounts receivable and you add an increase in accounts payable and vice versa. So subtracting out increase is just equal to the previous year's accounts receivable. So adding the previous year minus the current year. Just mathematics and algebra. So therefore we have because we gained $30,000 in accounts receivable from the previous year, we have a subtraction of $30,000 this year. And since they're right next to each other, we can just drag that down. And you can see that it moves along with that thanks to handy Excel. And then with accounts payable and other operating liabilities, it's the opposite way. So you start with this year, then you subtract out the previous year. So, and once again, drag this down, and you have this, and that flows there. And then you sum everything up to get a cash flow from operating activities of $87,500. CapEx, we spent $20,000 buying a stove, so that's $20,000 in CapEx. And then we had 0 changes to purchases of tangible assets. So we sum those together for an investing activities of $20,000. Again, if you remember from the last line, we paid $10,000 worth of dividends. We had no additions in long-term debt. We paid down $20,000 in loans, so that is $20,000. We had no proceeds from stock issuances because we did not issue any stock, but we did purchase $10,000 worth of common stock back. So you have minus $10,000, and you sum everything up for net change flow from financing activities of $40,000. So here you get a net change in cash of, adding those two together, gets you to $27,500. So therefore you have cash from the previous year plus the net change in cash from this year to get ending cash of $312,000, and voila, total assets and total liabilities and shareholders' equity balances. So note, we forgot taxes, but let's say taxes was like 25%. So of pre-tax income, you get taxes of $22,125, and you can notice that because everything works out, the total assets and total liabilities and shareholders' equity still balances because our net income flows into retained earnings, but also we don't get as much cash because we paid cash out to pay down the taxes. So revert that back because apparently I forgot this world is not taxation. So you might be wondering about the direct method. So basically you can see here, this will be, I'll send this out, but you can see that 25, if we just calculate all the changes in cash, we do eventually get the same net change in cash. So just a matter of going from the indirect method versus directly calculating every single time cash is expended. So that gets me $27,500. And again, if anyone has questions, feel free to email me or just talk to me at our club meeting. Nice. So that is it for the accounting exercise. So now let's talk about the different filings as well as the different filings and enterprise value. Cool. So basically, the most common type of filings is the 10K, the 10Q, the 8K, the proxy, a securities offering, and 20F. So the 10K is filed annually, and it's a very comprehensive document covering annual financial statements, latest share counts, business description, and manager's discussion analysis, and detailed footnotes on the results of operations. The 10Q is a quarterly filing filed every quarter, so it has far less detail, i.e. it stripped a lot of the detailed footnotes in MD&A than the 10K, but still has a good amount of information. And it's missing critical information on options tranches, which means you must rely on a prior 10K. Don't worry about this until next week. We'll be talking about that when we talk about fully diluted shares outstanding and calculating that. The 8K is a press release, and it's filed whenever a major event happens. And it's most common when earnings are announced, but it also includes acquisitions, etc. So it's far less detailed than the 10Q and 10K, but it also does sometimes include supplementary info like investor presentations that will shed some more light on the business. Next, you have the proxy. So this is used when you're soliciting shareholder votes. And if this is the most recent example, most recent filing, this will be a document you want to get the most recent basic share count. You have the securities offering. This is when companies issue more shares. And the most detailed one of these is the S1. So it's filed when a company decides to go public in an IPO. And then you have the 20F, which is similar to the 10K, but used by foreign companies with stock traded in the United States. So now you have the structure of 10K. Again, it contains a lot of parts, but the most important ones are highlighted in yellow. So this is the business, description of operations, etc., the risk factors, the selected financial data, the manager discussion analysis, financial statements and supplementary data, and then the exhibits and financial statement schedules, etc. And item 15 is just various pieces of information that could be useful but not disclosed above. So, for example, this summer, we worked with a company that had a lot of partnerships with banks. So a lot of the contracts were in item 15, and that kind of gave us a lot of perspective about how the business worked. And the rest is generally not so important for financial analysis, but they're disclosed in a 10K. Cool. So let's just go over the 10K real fast. So for this, we've chosen to use Kellogg, which is everyone's favorite cereal brand, although they have a lot of different they have several different sorts of operations and snacks offered. So you can see that this is the cover page, and here somewhere is the there are currently 343 million shares of common stock that were issued and outstanding. So here is part one, the business. You can see that Canadian company, financial info on about segments, that's located in note 18. Its products, its CSR policy, global sustainability, etc. So everything you want to know about the business. And then next 1A, you have risk factors. So here, this is honestly a lot of fluff because they want to disclose as much as possible, but you can see a lot of generic ones. For example, this top one is, if we pursue strategic acquisitions, we may not be able to successfully consummate favorable transactions or successfully integrate. And yeah, this is basically a common sense one. If you acquire someone, you might not be very successful in incorporating them into your core businesses. So next, if we go down, you can see that we have a bunch of risk factors actually, like several pages. Again, they're trying to disclose as much as possible, just to comply with SEC regulations. So again, it's a lot of fluff. And here you can see that a lot of quick items that eventually get us to, if you go down, the selected financial data, item 6. So this is just summaries of everything instead of full disclosure, but this is a summary of key operating results. Going further down, you can see this is actually a relatively long section for the selected financial data. Normally it's actually a bit shorter, but they have a lot of segments in a lot of different countries. Then going down, you have item 7. As soon as I can find that. Right, so 7, this is manager discussion analysis. Actually, I believe this top part is, we probably skipped a section. But you can see that here is a lot of the manager's discussion about what is going on in the business. And it's very lengthy, so you can read a lot about this for like what they plan on doing in the future, their analysis of what things were unexpected, were expected, etc. And then if you go all the way down, you can see financial statements, supplementary data, consolidated statement income. So this is the income statement, the balance sheet, and then this is a statement of equity. It's just saying who owns what types of equity exists. Then you have consolidated statement of cash flows, which is a cash flow statement. And then you have a bunch of notes to them. So you can see accounting policies that they disclose. You can see like a bunch of accounting policies about how everything works on the balance sheet, because again, each business is different from each other. So it's important to look at what the management is doing in terms of calculating the accounts when they're doing accounting. You can see other things, sales accounts receivable. This is just analyzing different accounts that they have. There's usually something, for example, goodwill and tangible assets. You can see that they have a lot of disclosures about intangible assets, etc. And then you have a bunch of notes. So unconsolidated entities, so people they've acquired, however, they're not consolidated within the operations. So a bunch of different nice things in notes. This is very helpful when you're doing financial analysis. And then all the way bottom, you can see some exhibits down here that are useful information but don't fit in any of the above categories. So from here to the 10Q, you can see that similar, there's a share count here, and then you have the jumping directly into the financial statements, and then some brief notes to them on the bottom. But as you can see, the 10Q is 59 pages versus the 10K is 148, so a lot less detailed. Here's an example of the proxy. This is when they're saluting shareholder votes for something. So you can see that down here in the first page, they mentioned that 343 million shares of Kellogg common stock were issued outstanding. as of the meeting in February 28, 2019. This proxy is not so. This 10Q is more recent than this proxy. So than the most recent proxies. So here, if you're trying to get a basic share count, you will go to the 10Q. And then you have the earnings, which came out before this, just announcing earnings before they filed the 10Q. So as you can see, this is only 24 pages now. And you have some financial summary. There's some income statement, cash flow statement, balance sheet, and then just pretty short, a lot lacking in the notes and analysis. But this is kind of the press release to saying their earnings. And one final thing, just to show you all an S1. So if you go to SEC Edgar, which is where you get your company documents from. So we type in Uber, which is just that, and then you look at their S1 or the S1A. Actually, the S1A is the amended version of S1. So as you can see, a very long document, and this is Uber is basically just used to pitch Uber to potential investors to fetch a high IPO price. There's a lot of marketing fluff, and then you kind of have a lot of written prospectus, which is describing how Uber works. And then somewhere below here, it's significant financial statements in the last few years of operations, because again, this is a private company up until IPO, so they have to disclose what's going on in order to IPO in the first place. So that's it for the financial statement. So now let's talk about enterprise value. So, but first, more on stockholders' equity. So you have in stockholders' equity several different accounts. The most common is, well, every public company has common stock. So it's some nominal value pegged onto a share when it's issued. And then you have the additional paid-in capital, which is referred to capital in excess of the par value. So actually, let's full screen this. You can see that this common stock of Kellogg's has 25 cents par value. Obviously, Kellogg's is way more expensive than 25 cents. And most companies don't IPO for just 25 cents. But what companies do is you have capital in excess of par value, so APIC. So for example, like we pegged 25 cents to common stock, but let's say it IPO'd at $15. The $14.75 not in the common stock is part of capital in excess of par value or additional paid capital. So that is put into this account. You have treasury stock. So this is shares that are once issued but later repurchased. So it's considered a contra equity account that decreases from equity. So it could actually be greater than common stock plus additional paid-in capital, because again, remember our historical cost assumption. People may buy a stock for $10, and that is recorded in the value of stock on the balance sheet. But if later we repurchase shares with our accumulated return earnings, with cash. Sorry, if we repurchase shares later with cash, and the share rose to $25, then that means we will be paying more than it were issued for. And the reason companies would do that is because shares dilute earnings. So repurchasing those will give more earnings per share than you have more shares. But as a result, the treasury stock could actually be more than the common stock plus APIC. And you can see that is the case here because 4551 is greater than 105 plus 895. Then you have preferred stock. So this is stock which is often without voting rights, but it takes privileges over common stock in a form of priority to dividends, and also has claims on assets in the terms of bankruptcy but before common stockholders. Return earnings, explained above, it's cumulative earnings during the lifetime of a company, so net income adds to it and dividends subtract from it. And then you have the accumulated other comprehensive income. So this is an income or loss a company recognizes that are not reflected in income statement. So i.e. foreign currency translations or gain and loss or loss on sales of securities. So this is not related to the company's operations. Then you have non-controlling interests, which is basically if you own over 50% of a business, you basically consolidate 100% of that subsidiary onto your own financial statements. But because you don't own 100% of it, there are non-controlling interests that are owed to other people. So therefore, that is the non-controlling interest of on this balance sheet that are shares of subsidiaries that Kellogg does not hold themselves. Cool. So briefly on the enterprise value formula, everything you just heard from the last slide, throw it away, because the idea is enterprise value does not include stockholders' equity on the balance sheet. It's basically what it's currently traded at, which we'll talk about later. So idea is to consider what it would cost to acquire a company. So note that when you buy a company, you would pocket its cash, which saves you money, but you take on its debt because the debt obligations of, for example, Kellogg's are now yours if you acquire Kellogg's. So note equity value, I was alluding earlier, is the worth of the company to equity holders after all debt obligations have been fulfilled. So note it is not what you see on the balance sheet, because the balance sheet is historical cost, what it was when it first appeared. But equity value is the current share price, so it's outstanding shares times the current share price. And then debt and debt-like items are the value of companies owed to other parties, other than the shareholders. So debt is pretty self-explanatory. So preferred stock is, unlike common stock, no voting rights, but because they are paid back before common shareholders in the case of bankruptcy, and they also hold a special dividends, so which must be paid before any dividends can be paid to common shareholders. So there's an obligation to pay them before you pay dividends to common shareholders. So that sounds very much like debt. So it has a lot of features similar to debt, although it's not debt, but you still add back preferred stock. Again, non-controlling interest. You own over 50% of a company, but you consolidate 100% onto your financial statements. So there's an obligation to give the other shareholders their due, which is why the non-controlling interest is added back to enterprise equity value to get enterprise value. And then you have and then there are other components to it, for example, pension obligations or capital leases, and those are added in as well, but those are way less common. Great, so now let's calculate actually Kellogg's enterprise value. So you can see that this is the enterprise value for Kellogg. So this is so equity value is from CapIQ. So CapIQ is a database that basically pulls data from financial statements, and this is just their market cap as of a week ago. So now the rest is you go to their 10Q to figure out where that is. So the 10Q this is the most recent 10Q. So which contains all the information. So you want to go up to the balance sheet, which appears to be right here. As soon as I see that, nope. Cool. So this is the balance sheet. So now if we want to add in debt. So notes payable is just a debt instrument where notes are due within 12 months. So that is considered debt. So you have 568 of notes payable. Then you have current maturities of long-term debt. So you have 508 of current maturities. Then you have non-current portion of long-term debt, which is 8262. So you have that. And then you have a pension liability, which again is a pension obligation to other folks. And as explained above, it is considered part of enterprise value when you add back to it. So that's 619. And then you have that. So cash and cash equivalents, again, with the formula, subtract that out. So you have $340 in cash and cash equivalents. So subtract out 340. Preferred stock, Kellogg has no preferred stock, so it's 0. And you can see here that there are non-controlling interests, so it's 562. So summing all that up, so all plus, oops, so all plus, need to add in this one, so then you have $31 million, or $31 billion of enterprise value. And note all these values are in millions. And that is just a brief summary of how to calculate enterprise value. Normally, equity value, instead of just pulling off of something, you would actually calculate the fully diluted shares outstanding. and multiply that by the current share price. But for now, just to get a sense of the formula, I just pulled from the database. Next week, we'll be going over more about how this works and calculating fully diluted shares outstanding. Great. So the last part of today is just to go over a brief summary evaluation. And don't worry about this for now. We will be going each of these in depth in the coming weeks, at least the top three. So, but this is just a brief summary. So first is transaction comps. So this is a relative valuation that gives an indication of a company's worth based on how much similar companies were acquired in the past. So this tends to give the highest valuation due to acquirers paying a control premium. Because in order for everyone to give up their shares and for you to buy a company, you have to incentivize people to actually give up their shares. And what this means is you have to give them more money than what their shares are worth to get them to give up their shares. The second is discounted cash flow analysis. And this is just seeing the value of the present value of future cash flows of a company to eternity. So this relies heavily on assumptions. So those building models obviously skewed them towards the optimistic side, because if they're in a stock pitch, you obviously want to shed your stock in shed light on your stock as positive as a way as possible. And then you have the trading comps. So again, this is similar to transaction comps, but this is a relative valuation that gives an indication of company's worth based off of similar companies that are currently being traded in the market. So because there is no control premium and is granted in the current market realities, so it tends to yield the lowest valuation between transaction and comps and DCF. And then the bottom two is just other ones that people use. So there's an LBO or leveraged buyout. So this gives a floor valuation because it paints a picture of what a private equity firm is willing to pay to achieve their desired returns. And then there's a liquidation value. So this is the value of a company if it is liquidated today. Obviously, this gives an extremely low valuation because most companies are worth much more than what their balance sheet reflects. Just because like a business works together using their assets to generate future income. But if you just sold all your assets today, obviously it'll be worth a lot less. Great, so that's all for today. For next time, I would like you all to make the CapIQ account. And then I want you all to calculate the enterprise value for the stock your sector is analyzing. So it's fine to use market cap for CapIQ or Google or Finance for now, just to get an exercise sense of how it works. And for the other items, right on the Excel sheet next to the item, which filing, which page number you got the number from. Cool. Thank you all and see you next time.